In today's video, I want to do something different. I want to touch on a dividend darling, ticker symbol SCHD. If you are a dividend investor, you probably know which stock I'm talking about and you probably already own it as well. If not, let me explain the whole SCHD debacle right now. 2 reasons to buy, 1 reason to skip this one. So if you're interested in all of that, hit that subscribe button. Like if you enjoy this type of videos, we really appreciate that. If you want to support me even further, do check out the link down in the description and the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So at the time of making this video, we can see that Schwab U.S. Dividend ETF, or ticker symbol SCHD, is up quite a lot in the last 10 years. I mean, if we even go to the last 5 years, it's up close to 69%. So what's the big issue here, right? What's the big issue? Well, if you are really a short-minded investor, then you're going to look at the last month's performance, and this stock is down 6.8%. Oh my God, the last 3 months, this stock has barely moved. It's down 2.2%. The horror, right? It can basically be explained in 2 pictures. If you zoom out a little bit, you see the 1-year performance, you see the stock chart going up. I love this. If you see this, oh, suddenly I hate this stock, garbage stock. I don't want to buy any shares of that dividend paying monster anymore. And that's the problem recently, right? It's when things are going extremely well, that's when everybody wants to buy everything, right? When a stock goes up 20, 30, 50, 100% in a year or 2, maybe even shorter time frame, everybody likes the stock. But the moment that same stock starts to plateau or even drop, that's when people dislike it, which is quite strange, right? I mean, let's say one day, on Monday, you have a company that is suddenly down 8%. Nothing has changed, right? The business has not become 8% worse during that day. No, the stock price just became 8% cheaper. Unless, of course, it's a business-specific reason that the stock has come down, right? Reduced guidance, I don't know, lawsuits, whatever. Okay. But if it's purely the fact that the stock is down 8%, but the business is not now 8% worse, then you should like it, right? If you enjoyed buying something at $100, why wouldn't you be enjoying things to buy at $90 or even less if it's the same business? It's a logical thing to do. And especially when we talk about a dividend paying one that has seen its dividend payouts increase quite a lot. In the last 10 years, the compound annual growth rate here is closer to 11%. 10 years ago, you would be getting 9 cents. Today, you're getting 26 cents. Now, yes, it's true that if we zoom out since the inception of SCHD compared to the S&P 500, it has been underperforming, let's say. It's up 214% compared to 354.6%. Now, of course, we know that the big outperformance has come more recently. As you can see, right, the red line has started to outperform by quite a lot the last year or 2, which you can see here, the year difference. SCHD is up 7.45%, while the S&P up 25.12%. But of course, with SCHD, you get a nice dividend yield, and that dividend has increased at a compound annual growth rate of around 11% in the last 10 years. Now, why has it seen an underperformance compared to the S&P? Well, it's because of the top holdings. If we look at the sector breakdown, we can see that 18.81% is financials, 16.57% healthcare, then 14.33% consumer staple. By the way, this is on Coifin. There is a link also in the pinned comment. I know a lot of you have been asking about that, so it's always there. And then if we zoom out and we go and look for information technology and communication services, for example, that's only 8.7% and 4.51%. And of course, as we know, technology stocks, growth stocks, AI stocks, and all of that, those are the stocks that have pushed the Nasdaq, the S&P 500 to all-time highs. The others, financials, healthcare, consumer staples, those stocks have basically underperformed. If we look at the current top 10 holdings for SCHD that make up 41.06%, we can see that those are the following names: Pfizer, AbbVie, Coca-Cola, Cisco Systems, BlackRock, Bristol Myers Squibb, Texas Instruments, PepsiCo, Verizon, and Lockheed Martin. Now, if we dive a little bit deeper in each of those companies, I've made it quite easy here. It's a watch list that tells you basically the performance, the last 12 months, last 3 months, last month as well, 5-year compound annual return, and then the average analyst price target compared to the price we're at today. So here you can see that in the last 3 months, for example, most of these stocks are down. Cisco is the one that is up 13%, Bristol Myers Squibb is up 8%, and then BlackRock is up 6.8%. All the rest are in the red. Then, if we look at the average analyst price targets, Lockheed Martin sits 22.6% higher than the price we're at today. PepsiCo, 20% higher than the price we're at today. Pfizer, also close to 20%. Coca-Cola, close to 19%. Verizon at 18.12%. AbbVie, 12.87% higher. BlackRock, 12.6%. Texas Instruments, 11.7%. Bristol Myers Squibb, 7.2% higher, and Cisco, 5.75% higher. So on average, the average analyst price target is around 15% higher than the price it's at today. On average, that is just based on the top 10 holdings. And of course, with these types of companies, they are pretty stable companies. They have a long history of dividend increases as well. Unlike growth stocks, AI stocks, yeah, they might not present 50% growth or something like that. But when we have 2 full years where the stock market has gone up quite nicely, maybe going on the defense makes sense right now. Seeing weakness in some of those companies, they still pay a dividend, still increase the dividend. So buying something like SCHD could make a lot of sense, right? Especially since it is, let's say, down in the last couple of months. But as we've seen, if you zoom out a little bit, the stock has performed quite well. Plus, you get an overall nice dividend yield that does increase 11% or so. Well, that's the average, the compound annual growth rate in the last 10 years. The compound annual growth rate of the stock itself is also close to 8 to 9% in the last 10 years. So I guess you're getting quite good returns if, of course, you are a long-term investor. Now, we can do a little calculation here, a little simulation. If you start off your balance with $10,000, these are the criteria. A 10% dividend increase each and every year, right? We've seen it's a bit higher, but let's be a bit conservative. 10% dividend increase, share price increases by 7.5%, 0 extra dollars added, and you have to hold it for the next 20 years. What we're seeing here is that your start balance is $10,000, and after 20 years, your end balance is going to be $103,711, and you're going to get an annual dividend of $5,892. That has grown from $390 in the first year. Now, if you do not use DRIP, then your end balance is going to be $61,971 and not $103,000, which of course is a big difference. And the reason why you are buying these types of stocks is because you want to reinvest the dividends so that the next one will become bigger, the one after that, and the one after that, etc., etc. What's also important to see here is your yield on cost. You're starting off at 3.9%. After 20 years, you're already close to 60%. And of course, this is without adding any extra dollars. If you can add on a monthly basis, you can add on a quarterly basis. And of course, if you do that, your end balance is going to be much higher than the $103,716. So to me, it's pretty simple. If you are a dividend investor, why not buy today? Since it just became cheaper, right? Why not buy today? Second reason, in today's, let's say, environment, you might think that the markets are peaking, so why not use this as a sort of defense, right? Even if it goes down, you get a dividend. So with that dividend, you can buy more shares. And if the shares do come down, then you can buy even more shares with the same amount of dividends, right? Makes sense. Why you shouldn't be buying this is very simple. If you're not a long-term investor, and you are afraid that this thing, it's down 6-7% and now you're feeling, bad or afraid, you should just skip this. You should maybe even skip investing as a whole, because then, the feeling right now, it just doesn't make any sense. So that's about it. We usually don't really talk that much about dividend plays here, but since this is a very, very popular ticker symbol, very popular name, especially for dividend investors, there is an opportunity here. I think it made sense to make a video, share my thoughts on this. It's a logical play. Let's be honest, if you're thinking long run, if you're looking for that snowball effect, this is the logical name to pick. What do you think? Let me know down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.